Thank you. We can start.
So hello everyone, warm welcome to this latest webinar. Happy to be here with you guys. Wow, what a number of really crazy months that we've seen in the market. So we have a lot to discuss today compared to the last time that we spoke. There's been lots going on in the markets, but as usual, let's start off with a brief disclaimer. Please don't do anything untoward with the information that we provide you today. It's more the basis of commentary as opposed to hard investment advice. But with that said, let's have a look at the agenda then. So there's only two parts to the presentation today. First things first, we'll do a bit of review of the markets in May. What exactly has been going on over the US, over in Europe? What are some of the main negative factors in the markets? What are some of the positives that now started to show towards the end of May and early June as well? And then in part two, we'll get specific. We'll have a look at exactly what we are doing positioning wise across our funds, what kind of tactical measures we are taking now, and generally how our strategy has been developing over the last number of months and how it's likely to develop in the months ahead as well. But let's get going, guys. Let's have a look at May in the markets. As you can see on this slide here, the S&P 500 did not have a good time towards the end of April and early May. A really stark drop there, right? Over 4,500 down to below 4,000 in just a matter of weeks. Some stabilization that has started to occur here towards the end of May and early June, that should be said, and we'll get to that in a few minutes. The NASDAQ, the drop has been even worse there. So we've gone below the lows that we saw back in March. We crashed below those, and we're now hovering around the 12,000 mark. There's some signs of stabilization here as well. But for US equities, it really has been a terrible 6 weeks or so. If you look at the European side, things are slightly better. We get this very large downdraft here as well, like in US equities. Here you can see that in the DAX, but also in the FTSE MIB in Italy, but it hasn't been as pronounced as over in America. And the stabilization has also been better than over in the United States as well. So real negative drivers at work here, but some positives. Let's have a look though initially at the negative drivers that are weighing on the markets right now. Now, we're talking about the principal negative driver for the markets. That is the rate environment. As you can see there on the right-hand side, throughout April and early May, we saw a major move up in interest rates again. You can see that especially over here in the United States, a really massive renewed drive up in interest rates. Of course, that means there's pressure being put on the bond market and hence also on the equity market, especially on growth equities, right? Where earnings are more in the future, are hence more speculative, and speculative stocks are more sensitive to interest rate rises, especially when they occur rapidly. Then you can see a large drawdown in growth stocks, and that explains the underperformance that we've seen in US equities over the last 6 weeks compared to European equities as well, because there are more speculative growth stocks in America compared to Europe. Now, let's go behind the scenes a little bit here and have a look at why exactly are rates moving once more towards the upside with such ferocity. Well, there are two factors here that are really important to note. That's inflation and monetary policy. You guys know the story. Inflation had been moving up already throughout 2021, driven up by strong fiscal stimulus, supply chain issues related to COVID, et cetera, But this has once again been amplified over the last number of months by a couple of factors that have boosted inflation even higher. The first thing to note here is China's ongoing battle with COVID. So that is leading to significant more supply chain issues as the government has put more restrictions on the economy. As we know, factories have been closed, people haven't been able to go to work, ports aren't operating at full capacity, and that means you can't source the same amount of goods from China, which once again puts pressure on global supply chains and hence inflation as well. The war between Russia and Ukraine has also not been good news for the inflation outlook. And the channel through which this is being influenced the most is, of course, the energy market. You guys would have noticed it at the pump. You see oil prices and gas prices have really shot up over the last number of months, and this has been driving overall inflation up with it. And on top of this, central banks are becoming concerned now with their credibility, with inflation running very hot, so above target for such a prolonged period. they see their credibility at threat and hence are pushed into a more tightening type of regime, moving towards tightening policy and hence raising interest rates. So central banks have been pushed into a tighter policy direction by higher inflation. So inflation is pushing rates up, but also the central banks are being forced to act and hence are also pushing rates up as a result. And the result of all of this, of course, is that market interest rates have really shot up so far this year. And that has been bad news for the markets, especially for growth equities. Now, if that wasn't bad enough, what we've also had since April or so are signs that the global economy has started to slow. It had remained robust throughout 21 and early 2022, but now the last 6 weeks or so, we started to see cracks in the economic outlook starting to appear. So what's going on here? Well, consumer sentiment has really started to turn for the worse, and this is likely related to the prolonged high inflation that we've seen, which has been amplified now in 2022. You can see here on the chart on the top right-hand side, real wages have really started to plummet. Real wages are with inflation stripped out, so it shows people's purchasing power ability, right? And you can see that's really fallen through the floor now, and it means potentially that consumers will start to cut back on consumption. At least that's what markets are concerned about. And you can see this concern manifesting itself in the markets via the performance of consumer stocks. You can see that here on the bottom side, that consumer stocks have not been doing very well at all versus the market. There's been a significant drop-off here in 2022 that shows that the market is starting to get some concern, some fear around the consumer not being as strong as it was last year. Investors also have a firm eye on the housing market, and you guys know the housing market is the most interest rate sensitive part of the economy, right? Think of mortgage rates. Mortgage rates go up a lot. That means demand for housing is likely going to go down, and it tends to be one of the first sectors that turns over into a recession. And you can see that here on this chart here. This is the US Housing Market Index, which is essentially a survey of people that work in the business. And you can see that's really starting to come off from the highs. It's not a disaster, right? Like in April 2020 or back in 2008, but we can see it's really starting to come over, starting to roll over somewhat. So some people are thinking this is a canary in the coal mine, thinking that the overall economy will start to follow the housing market down. What investors are also paying a lot of attention to is the employment situation, right? They are looking for signs that layoffs will start rising. Remember, when unemployment starts rising, so 0.5%, 1%, it tends to escalate a lot further and we get into a recessionary spiral. That's something that we really want to avoid. And some of the survey data is starting to point in that direction. That hiring is starting to slow down. And maybe in 6 months, we could start to see layoffs. So there's been this fear that's crept up in the markets in April or May. But on the other hand, as usual, there's always push and pull in the markets. There have also, towards the end of the month in May, been some signs of stabilization. So what's going on here? Why do we see markets stabilize, like the NASDAQ stabilizing around 12,000 and coming off the lows? Well, we see three principal factors. I mean, the first thing, especially for European equities, which is really important, is that there's been a growing perception in the marketplace amongst investors that the war in Ukraine is going to be more of a localized conflict going forward. So the expectation is that this will be contained to Ukraine. It might go on for many years, but there's less potential now for this spilling over and becoming a European-wide war and hence dragging down the global economy with it. There's less fear of that now, so there's less need to price in risk in European equities. So that's boosted prices here, but also for global equities, not just European equities. Second, and probably most important, is that there are potential signs. So some investors are seeing signs that inflation may be starting to near the top. It may be peaking soon. So why are they thinking this? We have China, for example, which is opening up again, right? We know that they've opened the restrictions in Shanghai and Shenzhen. They've lessened these, so ports operating better again, factories operating better again. So China will be less of an issue for supply chains going forward. And there's also some evidence that the inflation data, at least over in the US, is starting to slow down, that we're seeing a bit less momentum in inflation. Here you can see that with this index here, it's starting to roll over the last couple of months. And for some people, this is a sign that inflation may be reaching a peak soon. And importantly, if inflation reaches a peak soon, this means there's also less risk of a policy mistake by the central banks, because if inflation comes down, they don't need to act as aggressively to raise rates. And of course, that is a positive aspect for markets, and I think explains a lot of the stabilization that we've seen in recent weeks at the end of May and early June. All right, so much for a review. I hope that was clear. Now let's get into the way we are positioned. What exactly are we doing? And before I get into the real nitty-gritty of what we've been doing, let me just reiterate a couple of things about our approach. Right, our investment strategy is systematic. What that means is that the investment strategy is driven by a quantitative approach. So we make decisions as investors based on algorithms and models, right, on numbers. We do not make subjective judgments. So what my boss thinks or what my colleagues think, what an analyst thinks, you know, depending on how we get up in the morning, we'll make this decision, etc. No, we don't do that. We don't let subjective judgments come in. We let the models and the algorithms guide us. Of course, we know generally where they tend to go because we've designed them, but still, we let them guide us. And I think for us, it means that we can offer a more efficient, a more disciplined and consistent investment product for you guys. So that said, what is the main model that we use telling us? The main model for the big picture, so for asset allocation decisions, looks at two main facets of the global market picture. It looks at the monetary environment and it looks at the economic environment. So the monetary environment, as we've explained in the last number of months, has really been flashing red. It hasn't been a good time for the monetary environment, its impact on stocks. It's not ideal for risk assets, right? There's no doubt about it. You guys know the story. Inflation remains elevated. It's above central bank targets. They continue to tighten. Higher rates means that valuations start to come down, and it's potentially a headwind for margins and earnings as well. Having said that, over the last week and a half or so, we've seen this starting to bottom. So maybe we're seeing peak hawkishness in monetary policy, but still overall, it is not great for risk assets. So a lot has been resting on the economy. So what's been going on the economic side? And things have been getting worse, there's no doubt about it. So a recession, we can't say that it's very, very likely, but the risks of a recession have certainly risen over the last 2 months. As we saw, inflation is starting to hurt the consumer considerably. There's been some signs of slowing hiring amongst businesses. The housing market is starting to turn over as well. And overall tighter financial conditions, you know, with higher bond yields and a lower equity market, that is starting to impact activity as well. So there's a lot riding here on the economy and a potential recession. And this is really important to note because you can see there's a very much a tight relationship between bear markets, so falls of 20%, and a recession coming up. You can see 90% of the cases, a bear market is associated with a recession. There's only been one case of the last 40 years where that wasn't the case, and that was in 1987. And people still have no idea what caused that bear market. But usually, yes, they're always associated with recession. So we need to be on keen lookout for recessions in order to make the best asset allocation decisions right now. And to come back to the model then, here you can see the development of the model over the last number of months. And you can see that the monetary side has been negative, right? It's been negative all along as central banks have gotten tighter and tighter over the last 6 months. But the economic side was holding up quite nicely at the beginning of the year. but now in April, it's come down a bit. And now in May, it has turned negative. That means that the risks of a recession for us have gone up considerably. And it means also that in terms of investment strategy, that we need to be more cautious now. And what further underpins this idea is the fact that volatility as well has become a significant concern in recent weeks. Right? You guys, I think, know this market volatility has continued to rise during this period, and it means that the markets contain more risk. And you guys know, one of the essential components of the forward quant concept is the control of risk. They are called risk control funds. And this we can determine given the rolling level of volatility, which you can see here, which basically is just volatility over a look back. So over 1 month period, 6 month period, 12-month period. And as you guys can see here, is that volatility over a 1 month period has really started to shoot up. Over 6 months, it's really moving up considerably here. It's the highest for over a long time. And 12 months is being pushed up as well. And as this happens, that means for us that we need to turn more cautious. And why do we do this? Well, by keeping volatility lower, so bringing this vol level down, it increases the downside protection for us. Because during these higher volatility phases in the market, there is more potential for large drawdowns, right? For markets really to collapse 15, 20, 25% in really short order. By controlling volatility, we dampen this risk. So what does it all mean in terms of asset allocation? Well, it means a lower equity allocation, right? So we reduce risk by cutting equities. Why? Well, the recession risk is rising and volatility levels are getting uncomfortable as well. What do we do with bonds? Well, this is not a good environment for fixed income, no doubt about it. Higher inflation, higher rates, bad for bonds. So we have a low allocation to bonds. We've upped the allocation to cash. So there's little return to be made in cash, as you guys know. But the positive side is that you can reduce your market risk by upping an allocation to cash. Right, so what are the tactical measures have we been taking over the last number of weeks? Well, we continue to use derivative strategies, right? So we have a strategy of a targeted use of put options to protect large portions of the portfolio. What this does for us, this targeted use of put options, it provides further protections during market phases that are much more prone to downturns, right? It's like lowering the volatility. We provide more protection to the portfolio from severe downward moves in the market. What else have we been doing? We've also been engaging in sector shifts. So we've been moving the portfolios towards parts of the market that are more immune to recession risks. So this is leading us to, for example, healthcare, which is scoring very well on our models and algorithms right now. Why is that the case? Well, in healthcare, the earnings are much more defensive, right? So even if you're in a tough economic environment, you'll still spend money on healthcare, as it were. And it's more inflation proof as well, as we've seen over the last 30 years of history of healthcare. When inflation really starts moving higher, healthcare tends to still do well. Even if prices elsewhere are high, you'll still spend money on healthcare. So as a defensive sector, it's been very good. Now, what we do as well is that we screen for sanctions. Now, this is a question you've been getting in quite a lot in recent times. And as a UCITS manager, we should point out that we are constantly screening our investments for companies that fall under sanctions. You guys know this is very important now, given the war between Russia and Ukraine, to really ensure that we apply these sanction lists that are being produced by the EU regulators and the US regulators. This is being checked all the time, so you can be safe in the knowledge that all the sanction lists are being applied across all of our funds at FWU. Now, we've spoken in fairly negative terms today, but I think we need to provide a little bit of perspective here as well. Here you can see wealth generation over the last 150 years in the United States. And you can see that, yes, you have recessionary periods. You have periods where growth isn't too great, but wealth creation does continue, right? So even if we see a recession materializing in the coming months, we should bear in mind that market economies are resilient and they will return to growth at some stage. They know how to generate wealth. And so unless you think the market economic system is going to completely implode, then you should still be interested in buying equities. And you can see this correlation very nicely. So equities correlate with economic growth. You can see that equity earnings, so company earnings, are very much intimately related to GDP and hence also stock prices. So if the global economy recovers, earnings will recover, and at the same time, stock prices can still do well. So over the medium and long run, equities are still a good investment. I think that's worth stressing. It's always some perspective needed when people are a bit more fearful, as you see in these current market times. But you always look at, we are very good at generating wealth. And I think that hasn't changed over the last 3 months. We will return to that at some stage. So, key messages for today, guys. There's been more pressure on the markets over the last 6 weeks. Why? Well, we've seen rates moving up, so that's causing volatility in the markets, putting more pressure on the growth areas of the stock market. On top of this, we've also seen fears around the growth outlook starting to emerge. Inflation is starting to hurt the consumption outlook, and supply chain issues are hurting the business outlook as well. Although we see some stabilization coming in towards May, because we could be seeing peak inflation, but it's not sure yet, but that's behind the stabilization. Now, what does it mean for us? It means we have been taking a more cautious stance. So a recession is not a done deal, is not sure, but the risks of a recession have gone up, as we note here. The models show that the global economy is potentially starting to roll over now. There is this concern, right, between this key relationship between bear markets and recessions. Bear markets only tend to happen when recessions are around the corner. So we really need to gauge if a recession is there or not. And it looks as though that the risks of one are rising. So it means lower equity allocation, moving them down to neutral, and it means targeted hedges are necessary via the use of derivatives, specifically with put options. But with that said, I'll leave you guys. I hope you have a fantastic rest of the week. If you have questions, please address them to your local representative, and they'll then get back to us and we will answer all questions. But with that, I thank you guys very, very much and have a fantastic rest of the day and rest of the week. Goodbye.